When a company buys office furniture on credit, the liability is fixed. You have a physical invoice, a specific price, and a set due date. But accounting becomes more difficult when a product fails in the field or a lawsuit is filed. These scenarios involve a present obligation, but the timing and the final cost are both unknown. To ensure these uncertainties are reported consistently, accountants follow IAS 37. This standard provides the framework for determining when a potential future cost must appear on the balance sheet and when it should simply be disclosed in the notes. Under IAS 37, a provision is only recognized if it meets 3 specific criteria. First, there must be a present obligation resulting from a past event. Second, it must be probable, meaning more likely than not, that an outflow of resources will be required. And third, the company must be able to make a reliable estimate of the amount. These 3 requirements act as the formal threshold for recognition. If any of these conditions are missing, the item cannot be recorded as a liability on the balance sheet. This ensures that financial statements only include obligations that are grounded in high probability and measurable data. To see how this works in practice, consider Aerotech, a company that has just sold 1,000 professional drones. Each drone comes with a 1-year warranty, meaning Aerotech is now obligated to cover future repair costs for the entire fleet. We know a past event has occurred, the sale, and that an outflow of cash for repairs is probable. However, we face a measurement problem. We don't know exactly which of the 1,000 drones will require service. For large populations of items like this, we use the expected value method. Aerotech's historical data suggests that 80% of the drones will have no defects, 15% will likely need minor repairs at $100 each, and 5% will need major repairs at $500 each. We calculate the provision by weighting these outcomes by their probability. We take the 15% minor defect group at $100 per unit and add the 5% major defect group at $500 per unit. This calculation results in a total warranty provision of $40,000. By using probability-weighted averages for a large group of items, the expected value method allows us to reach a single, reliable figure for the balance sheet, even when individual outcomes are uncertain. Not every obligation involves a large population. Suppose an Aerotech drone crashes, leading to a $100,000 lawsuit. Aerotech's legal team estimates there is a 60% chance the company will lose the case. We test the criteria again. Since there is a 60% chance of loss, the probable threshold of over 50% is met. We have an obligation from a past event and a clear estimate of the cost. A common error is to weight this single event, multiplying $100,000 by 60% to get $60,000. However, in a legal settlement, Aerotech will likely either pay the full $100,000 or nothing at all. This is why IAS 37 requires the best estimate rule for single binary events. This chart compares the 2 methods. While we weight a population of warranties, for a single lawsuit, we record the most likely outcome in full. In this case, the $100,000 is the best estimate. Some obligations are certain but distant. Aerotech is legally required to dismantle a testing facility in 5 years at a projected cost of $250,000. Because this cost is several years away, we must consider the time value of money. Using a discount rate of 8%, pause here and calculate the value of the provision that should be recognized today. We calculate the present value by dividing the $250,000 by 1.08 to the 5th power. This gives us $170,183. We record this by debiting the asset and crediting the provision. Discounting long-term provisions prevents a company from overstating its liabilities, reflecting the fact that the actual cash outflow won't happen for years. Now, consider the reverse. Aerotech sues a supplier for providing defective parts. Their lawyers believe there is an 80% chance Aerotech will win a $50,000 settlement. We have an 80% chance of an inflow of resources. Earlier, a 60% chance was enough to record a liability. Does that mean Aerotech can record this $50,000 as an asset now? No. IAS 37 applies a more conservative standard to assets than to liabilities. As this comparison shows, a liability is recognized when it is probable, above 50%. A contingent asset, however, requires virtual certainty, usually 95% or higher, to be recognized. At 80%, this is only a contingent asset and is limited to disclosure in the notes. This matrix serves as a summary of how probability dictates the accounting treatment for these items. It maps the different levels of likelihood against the required action for both assets and liabilities. This framework provides a clear path for deciding when to ignore, disclose, or recognize an item based on its specific probability. While complex cases still require professional judgment, this matrix is the starting point for navigating the reporting requirements of IAS 37.